You're listening to financialradio.co.uk. My name's Giles McMullen, chatting to Bill Rook from Redmayne Bentley. Hi, Bill. Let's start with the 250, which has been it's been a nasty market, really, to be trading for a while, but not recently, you would say.
It's interesting, the 250 against the 100. The 250 over the last 3 weeks has been up about 8.5%, which is staggering. And the 100 about 2 and a bit %. So they're out of kilter. And what I've done here is put it into the chart. It actually measures on the purple bit with the black line. Is the key thing here, and the zero line. When we go above zero, we know that the 250 is outperforming the 100. Now, this doesn't happen very often. It did for a while back when we had a reasonably bullish period in the market, but recently it has not been there, and it had flickered between October and September and October. It just flickered for a little while. This is quite the longest period we've seen this go for a period of about a year or so, a year and a bit now. And it's quite an outperformance by the 250, and I think at the moment the 250 is probably using the fourth indicator, the one with the pink background. It's a CMO indicator. It suggests we're overbought, I think, at the moment. Again, on the 250, I think the 250 is going to peel off a bit now, cool off. It's down a bit today. We've taken profits, and we're going to sit on the sidelines and wait until this comes good again. Although the period when it took off in April was certainly matched with some good trending indicators, which supported the move in. Maybe a bit premature on our behalf, but we're taking a good percentage, maybe 11-12% in about under a month, which I think on an indices is very good.
Well, I think if you look at your risk profile in investing in an index like the 250, and then you look at your return, I don't think you can argue with that. 11% over 4 weeks on an index like the 250 is a very good return. It
is, and we'll sit back and wait now. The 100, interesting enough, today is only down 0.55, so it's on a micro scale, and the 250 down 2.75%. That's cooling off. It's going to come again, and everything does. I think everything has its turn, and this is one of the things we're seeing with this market is, and I'm believing, it actually when it goes up, it's got to come down in order to prove that this is the bottom. And it's got to bounce off it, and this is the thing I think clients will remember, is that we've got to have a cooling off, and it won't all just be easy play, everything going up. And this is a trader's market, it really is. And I think the mentality of it behind this is that you've got to, if you're in this market, you're either going for longer term recovery or perceived value recovery, which will be looking for companies with good earnings forecasts and good growth prospects. And they're few and far between, but the things are a lot less worse than they were, but we're not out of the mess yet.
Okay, Bill. Well, that's the 250. And what you say there makes a lot of sense. Let's move on to another... I suppose it is an index. It's the oil price, which again has had a very rocky ride. Over the sort of last year or so, having touched 147, and then what did it go below 40? It's been building though, the price recently, hasn't it? What do you think's going on?
Well, I think it's part recovery in America, and things aren't as bad, and a push from the emerging market scene, and certainly mainly China. Chinese market is one of the strongest markets. Brazil, China are the two strongest markets that I've seen. Russia's in for the moment as well. So the BRICS are doing quite well. The Brazil, Russia, India, China. Those are the strongest markets. And we're seeing some uptake of the slack. And this is mirrored by what's going on in the oil market a bit here. Currently, we're looking at possibly short-term overbought. The CMO indicator again hitting the highs, and it's done this again. We did this before when the oil price hit the 150 level and cooled off, but it is again going up that sort of level. Short term, we've got reasonably supported by indicators on the positive side. So it looks like it's going to go higher, but pressurised by overbought short term. So the mix at the moment, very mixed indicators coming through. But the main thrust behind this is it wants to go to the red line on the chart. The red line on the chart is the 200-day moving average. We talked about this before. That's about where 63 level is. That's where I expect the oil price to go short term, is the 63 level version to the norm, I suppose, where the 200-day moving average is, and that's where we're headed. And it may be a bit jiggly on the way, but I think that's the underlying area where we're heading. being very, very oversold in February, being very, very overbought last June, July. So that's the target short to medium term.
Do you keep an eye on the dollar when you're watching oil?
Yeah, we do, and this is one of the reasons why the big fall off in happened late last year. Is the dollar went very strong, and the dollar will be represented also in the markets as well. When the markets are strong, the dollar will be weak, and this is what we're seeing at the moment. Is a reasonable strength. I think people are willing to speculate on euro, on sterling, more so than the dollar. Dollar and yen are probably historically hedged. The sort of the stronger when things are bad, people will buy the dollar and the yen. We're seeing certain weakness, people wanting to take risks and sell dollars to buy other asset classes, and that's why we've seen the rise in commodities based on this as well. So there's a bit of a mix in here as well.
Okay, what about mining, Bill? That's the next chart.
Mining is interesting. Again, supported by a lot of interest. Now, what I've done here, and this is one of the problems with the 200-day, and everyone says, well, what about the 200-day? It's all very, very good. I've highlighted this one. I want to introduce one topic here. Is say, look at the red line on the bottom of the chart there, and there's sort of 1, 2, 3, 4, 5, 6, 7 circles there, and they indicate where the 200-day moving average has been broached by the underlying. This time, it's the FTSE mining the sector, the top 350 mining stocks and each time it's broken down. Now, they could have produced false alarms at any one time, but there's one indicator which I think is so powerful, which I think it should be part of everyone's trading tool box. It's the MACD. The MACD only goes down once, and that's in August. Since this indicator's been fashioned since 2006, it's only gone down into a state a negative state in August, late August last year, and that's basically when you get out of the sector, ideally. Now, there've been lots of false dawns, and the false dawns can actually say, well, it's been to the 250. For the traders' mentalities, it's been through there before, I'm okay, because I'm sure that the China, Brazil, India, Russia will be okay generally and longer term. But then what actually happens is it breaks down, and this is just a reminder of how powerful a tool the MACD is. It's still in negative territory. So again, like a lot of other indicators, a lot of other indices, sectors, they're all mainly in recovery phase. While the MACD is still in negative territory, these markets are in trending phase. Although the short-term indicators, the price oscillator and the inverse fissure at the top, suggest there is trend returning. It is very much a trader's market, and the mining industry, yes, it's above the 200-day moving average. If there is a cooling off, and there might well be a cooling off because we're hitting that sort of CMO levels, hitting the high thresholds again, we expect it to cool back probably down to the 250 to the 200-day moving average, the red line. Tracking the markets there, and before further upside resumes. So I think this one is emerging from the depths as a very, very good trend. It's sort of it must have got 50-odd%, Giles, I think there since March on. It's an amazing run there, and it's going to cool off a bit before it goes higher, I think. But certainly it should be part of the portfolio, but it's going to cool off short term, I think.
Okay, Bill.